Splendid evening it is to viewers. Welcome to Equity News on EquityAxis, your business and economic insights in Zimbabwe and beyond. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's roll. In line with the digital trends in Zimbabwe and beyond, Standard Chartered Bank has launched a mobile platform known as the SC app. According to the bank, the mobile facility has over 70 services and is meant to improve the banking experience. We're to close up with their head of retail operations, who is Valeta Mtimkulu. Let's have a look.
For us, it is a digital bank. And it has been an exciting journey for us as Standard Chartered. We started this journey in Cote d'Ivoire, and Zimbabwe was the 7th market to roll out the app. And the reason we call it a digital bank is that it does everything that our clients have become used to doing in any of our branches. So let me just take you through what we would read as a digital bank. And it has been an exciting journey for us as Standard Chartered. We started this journey in Cote d'Ivoire, and Zimbabwe was the 7th market to roll out the app. And the reason we call it a digital bank is that it does everything that our clients have become used to doing in any of our branches. So let me just take you through what we would already know, right? So we know that, on the app, on the SC online app that was already in existence, you could pay your bills, you could transfer money, you could view your statements, you could do all of those, daily routine transactions that we all do digitally now. In addition to all of that, what we're excited to bring to our clients is the fact that now they can do a lot more on our digital bank. So let me give you a few examples. We have added about 70 additional services on this app. 70. So what that does is takes all the other activities that clients were having to spend money on to travel to the branch to do. So let me give you a little bit of color on that. If a client, for example, changes address, they would have previously needed to take a copy of their new water, electric bill or whatever proof of address. Make sure they get on a combi or drive or whatever their mode of transport, come to the branch, give us that, and so that we'd use that to update our records. With our new digital bank, all the client needs to do in the comfort of their home or whichever place is to take a photo of it and upload it on the app, and immediately that will come straight to us and we'll update their records. For us, it is a digital. So strategy for Zimbabwe is run in Zimbabwe. We are part of a global institution, so there is alignment, obviously, in terms of what we're doing, but we always run the Zimbabwean strategy in terms of what works for Zimbabwe. That being said, there are benefits of being part of a global institution. You talk about digital. Earlier you talked about the Zanaco example.
Affirmative.
Part of the way that we would roll out, whilst it may appear that maybe we're not as fast as the market, the way that we would approach it, building on our international expertise, may mean sometimes that we are not as fast, but it does mean that what we roll out is robust, it is tested, it is up to international standards. And that is the benefit of being part of an international enterprise. It doesn't mean in doing so that we are not playing to the local scenario. What it does mean actually is that we make sure that what we
Meanwhile, trade stats for the month of May reveal an improving trade balance position, with the trade stats for the month of May coming in at a negative $94
so strategy for Zimbabwe is run in Zimbabwe.
Of a deficit of $140
we are part of a global
million.
Institution,
Cumulatively,
so
over the first 5 months of the year, Zimbabwe's trade deficit improved 300% to $332 million in a deficit position against a 2018 performance of $1.3 billion. Now let's just get into the stats to get a detailed analysis of how Zimbabwe has performed in the past. So this here would be from June 8 of 2018 to May of 2019. Now, of interest there would be the fact that in the month of May, we reported $94 million. This is according to information that is coming in from Zimstats, against an April performance of 140 million Zimbabwean dollars. March there at 33, February 22, January at 44. So over the first 5 months of the year, this would give you a figure of 333. Compare that to how Zimbabwe performed in the year 2018, when we reported $1.3 billion in a deficit position. Stats prove that there's actually been an improvement. Now, to get into the teensy-weенsies of these figures, we would have a look at Zimbabwe's fuel imports by value. An interesting stat here is the fact that in 2019, there's actually been a 21% decline against the 2018 performance. In 2018, where there was an increase in money supply and an economic boom in that regard, there was actually a significant demand for fuel, resulting in a significant jump where our fuel imports were concerned. So now, our fuel imports have actually declined by 21% back to the 2017 levels. That would be something interesting to note there. Now, a big one as the country grapples with electricity shortages. Stats show here that Zimbabwean government has actually reduced fuel imports by a whopping 79%. Now, of course, we are very much aware of the fact that we are grappling with water levels at Kariba, as well as maintenance issues in as far as Hwange is concerned. But at this point, stats prove that part of our crisis is the fact that government, under austerity for prosperity, has reduced our electricity imports by a good 79%. So you look at 2017, where we imported an average of $16 million worth of electricity, 2018 an average of 17 million, and now we are importing on average $3 million. This is actually what we have playing out and affecting the figures where electricity is concerned. Now, as we make progress, the Minister of Finance, Professor Mthuli Ncube, has indicated that on the 31st of July, he will issue an interim budget, which he says is meant to alleviate the tax burden that is currently affecting the Zimbabwean citizenry. Meanwhile, the workers' unions have rejected government's offer to increase salaries by just 97 Zimbabwean dollars. This, of course, the aggregate figure would come to 200 million Zimbabwean dollars. Argument from the workers' union is that the amount is too insignificant in the face of soaring inflation, which came in at 97% in the month of May. Now let's have a look at the stats in detail in terms of what this would mean in terms of the fiscus. Now, Professor Mthuli Ncube, in his maiden budget, set a target of $4.1 billion for expenditure where employees are concerned. In January, once-off payment of $200 million. Then in May, an increase of $400 million. And now the July offer comes in at $200 million. This means that there is actually an $800 million which was unbudgeted for in this $4.1 billion. So that would increase it to just about $5 billion. Now, this would be a situation there that government would need to address as we make progress. Meanwhile, the Reserve Bank of Zimbabwe yesterday auctioned treasury bills for the first time in 10 years. This was a measure which was meant to to have a look at the market, make an assessment of the appetite of the market for these treasury bills in that regard. And now it is actually being reported that we could be looking at infrastructure bonds that Zimbabwe will be also rolling out. This concludes our evening news bulletin. Up next is a look at the news review. Please stay tuned.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe with a complete range of activities including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
Welcome back, viewers. It's now time for news review, and with me is Chief Analyst Respect Kwenzi. Respect, good evening and welcome to the show.
Good evening to you too, and my pleasure as always.
Splendid. Now, let's get to the business of the day. First and foremost, the Finance Minister has hinted on a supplementary budget soon to be rolled out on the 31st of July. Your perspective where that is concerned, what can we expect?
Obviously, there is a revision that's coming along. The budget was initially set at 8.1, but according to the statement that was issued in Parliament in April, when the Minister was addressing parliamentarians, he showed that the budget will be revised to about 12 billion from 8 million. I think that you can calculate the growth in terms of percentage terms, but by implication, that also means we are now demanding more resources to satisfy that increase in expenditure. So from an initial budgeted deficit of about 1 billion, we are now looking at 4 billion. We are now looking at 2.8 according to what the Treasury is budgeting for. And within that same spectrum, we now expect the revenues, country's revenues as collected by ZIMRA to go up from an initial projection of about 6 billion to about 9 billion this time around. And that would give us a net deficit of about 2.8, given that we might get some other concessionary funding that government is projected to be about 1 billion thereabout. So that's a deficit position. But according to government's own calculation, given that they've now assumed that their GDP levels in RTGS terms will be at 72 billion, which I believe was arrived at by simply putting a certain exchange rate to say if last year our GDP was 22 billion in USD, therefore maybe at a cross exchange rate of about 3 times, it would arrive at a GDP of about 70 billion. But not all variables within the economy were readily priced in USDs. If you look at the presentation by Marshhold at their recent engagement with the market, they explained that the reason why we could not ascertain the true value of our net asset value is because we failed to value some of our properties and some of our assets in because we didn't know the split that we should be using, because it's not every variable that was priced in US. Some of the assets were readily in RTGS terms. So I think the same applies to government as well. It's not every one of the produce that was in the economy that was still priced in USD terms, which means we might have overstated our GDP. But getting back to what it means to the fiscus, if you have overstated your GDP, it means your deficit to GDP level would also be understated. So in a way, if you increase your GDP level and then assume that I'll make such a deficit, by implication you are actually reducing the net deficit position, or you're simply trying to preserve it or conserve it to a level that is not really the actual levels that are implied by the figures. So my take around that is that, yes, of course, in July, which is just a few weeks from now, we'll see the minister present a secondary budget, which is a supplementary budget in this case, which will show a deficit position of about 2.8 billion. But I think as a starting point, if I am to touch at one of the issues that you pointed out, civil service wage bill, which has been one of the key concerns in this market. In 2018, we had budgeted for, in fact, we incurred 3.9 billion in terms of the civil service wage bill, which was almost above 75% of the net budget position, because our budget then was 4.5 thereabout. So on the net, this actually means that we were expending more of our resources on the employment side. But now getting into 2019, after the revisions, or after government is after we have factored in what government is now promised to be the net increments from the initial once-off payment in January, and another 400 in May, and now the 200, it would give us a figure of about 4.8 billion. And when you say 4.8 billion against the targeted expenditure of 12 billion, that would show you that possibly civil servants will account for less than 50% of the budget, but then that's not acceptable, because civil servants, they are readily getting incomes which are below, somewhere it's around 500 thereabout, and an increase of about another 100 will bring the figure to 600. And on the net, if you look at how much prices, or the level at which prices have risen, I think it is of course not fair. But for the sake of the fiscus, I see him truly trying to play around his cards. But obviously, they will give in at some point to possibly address the disparities between the levels at which prices have risen and the incomes that civil servants are getting. But also cognizant of the fact that any such not so commensurate increase will also invite inflationary pressures into the economy. So these are a whole lot of metrics that are at play, but there is a definite conscience within the treasury that we have to keep certain factors under check. We have to contain inflation. We have to contain the GDP deficit levels such that it becomes sustainable.
But of course, that's on the one hand of government and treasury trying to bring fiscal consolidation. But let's talk about the effect that this would have on the employee on the civil servant. I mean, inflation has been soaring, but there seems not to have been a commensurate adjustment with regards to their salaries, and hence we actually got civil servants actually rejecting the offer made by government from the civil service side.
I think one of the key factors that is often overlooked in evaluating policy measures is always to try to do a fair assessment of the downside in consideration, of course, of the upside. If you look at the ESAP of 2000 and early 2000s, in fact 1992, the net impact was that there was a deep decline in terms of our GDP levels. In fact, it was evaluated then that ESAP had more negative impacts to the economy than there were the positives. There was a serious erosion of value and also a serious erosion of demand in the economy, which obviously led GDP to fall by a very huge margin. Safe to say there was a drought in that respective year. And we have now termed it austerity, which are measures that are meant to realign the fiscus by primarily focusing on reducing your deficit levels and so forth. And so in the current scenario, in matters where you're saying, what does it mean to civil servants? Of course, it means that their purse can no longer stretch as far as it used to be, and they can no longer be able to execute their duties in as far as they used to do before. And that's a service that is no longer being offered meticulously or to its value or to its anticipated value. So there's obviously value that's being lost in the economy, either through less or lack of education, because these guys will no longer be able to offer their service on a daily basis. They will start to possibly reduce the the times that they go to work, maybe from 5 days to 2, and they might actually be doing some other things at that respective time, which forgoes the very educational value that should accrue to this economy. So that's a huge impact, and it also have got an impact of reducing aggregate demand in the economy, which is a function of spend. So if you can no longer spend, it means you can no longer demand, and goods will no longer be sold or will no longer be bought or sold at the respective levels in the prior year. So on the net, we will also see retailers and all service providers and so forth realizing declines in their own income, and by implication, it also means the tax authority will also realize lower incomes. And this is true not only to the civil service, but to the broader economy as a whole. There hasn't been a very commensurate increase in salaries, and therefore it means aggregate demand would come off, and it also means that GDP by implication will also come off as producers scale back, and as employees as well underperform due to non-payment of commensurate salaries in line with the depreciation of the local currency as well as inflation.
Still on a macroeconomic tip, we got this trade stats from, of course, Zimstats there, and what seems to be an improvement from the prior month's performance of about 50% from $140 million in April to $94 million. How significant are these figures?
So one of the key objectives of the current government is trying to deal with the twin fiscus, the twin deficits between the fiscus on the fiscus side as well as on the trade side. So there is a persuasion within government circles that some of these objectives have already been met. If you're looking at these numbers over the period between January to May 2019, our cumulative deficit is sitting at around 330 thereabout. When you compare that to the same period last year, we were sitting at about 1.3. So it means we are now in a better off position on a comparative basis. And if that trend is sustained, it means that by year end, we'll have a deficit level of less than 1 billion in terms of our trade deficit level. And that 1 billion could easily be overrun by money that we get via remittances and so forth, which means that on the net, Zimbabwe might actually end up achieving a net trade surplus at the end of the year. But now, I think my worry there is about the quality of the surplus in terms of trade again. When you look at the key aggregates of what we are losing, or what we are possibly losing by constraining, or by what is driving this net position, the decline in the net trade position, I think you can only see it maybe even through this chart. There has been a decline in terms of what we import in key factors of production, notably diesel, petrol, electricity, and of course other factors such as wheat, as well as soya bean. So these 5 key raw materials or factors of production have seen a gradual or a decline, a sharp decline actually. If you look at electricity, for example, there's been a sharp decline in terms of the monthly importation from an average of 16 in 2017 to just about 3 million in 2019. But what does that mean to production? It means that you can no longer produce as much as you used to do back then. So this consumption was obviously also production driven. Of course, there's part which is non-productive, but there's also a good part which was production driven. If you look at companies that reported their earnings recently, there is Woodell, which said our performance at year end will largely be driven by the availability of electricity. If you fail to get adequate electricity and adequate water, it means we cannot match or even do anything close to last year. So that means there is a huge factor there. If you look at mining companies, they also rely heavily on availability of electricity. So if they fail to get electricity adequately, it means their produce is also dampened, and miners are the ones that generate forex, and it means there will be a slowdown in terms of their own production and their sales, and on the net Zimbabwe is losing out in terms of forex and in terms of production. If you look at the general business across the service industry, they also rely on electricity. If you don't get electricity, you have to get a substitute, and that substitute is obviously other fuels, and to power your generators and whatnot. That is if you don't have solar and so forth. And on the net, it also means your cost of production or your cost of doing business is actually going up. So there has been a huge net impact in terms of our production, which has not yet been quantified to see the real net impact of this gain that we are now realizing in terms of our trade. So that downside is still to be addressed, but it will be fully addressed at the full year or at year end when we start to do our GDP numbers and see what amount of loss was realized in real production, which is attributed to a lack of these factors, such as electricity and the increase or in fact the unavailability of fuel, and even the increase in prices of that fuel, because it has also contributed to thwarting demand. So I think the net payoff is yet to be really quantified. If you realize a GDP decline of 10%, that's a huge amount, and it can easily wipe off the gains that you are realizing in terms of the trade side. Okay. So the payoff has to be balanced. So as policymakers, there has to be a real balance, and there has to be a real net payoff calculation.
Do you foresee that balance being reached?
No, we are simply focusing on one end of the things. We are saying we have reduced our trade deficit to sustainable levels, but those are not sustainable levels because you are failing to provide some other basics. You are not importing enough medication. You are not importing enough wheat to to afford people a decent life in terms of consumption, and that also means that you're actually worsening off another key aspect of the economy. So I don't think government is yet in control of those variables. They have no adequate forex, relying heavily on letters of credit, and there's still some subsidies that are going on in terms of electricity, and there's still even subsidies in fuel. So as long as prices keep on going northwards, tracking the exchange rate, it means government is not in control of such variables like the importation of these key commodities. But what will happen is that they will try as much as possible to try to have influence, especially on the trade in the interbank market, in trying to manage how some of these key imports are imported into the country.
I realize. Well, thank you, Respect, for the perspectives. Thank you, viewers, for staying with us. Up next is a look at the stock markets in Market Daily. Don't go anywhere.
Good evening, ladies and gentlemen. Welcome to Markets Daily on EquityAxis. My name is Anis Chumbumu. Joining me today is Respect Kwenzi, the Chief Analyst. Respect, how are you doing today?
I'm doing just good, and you, Anis?
I'm all right, thank you.
Sure.
Well, seems as if the $25 billion market has receded from a prior session gain, which had actually cut short a 4-day trend in terms of losses. Today it did come up by a marginal 9.95% for it to settle at 189.61 points on the all-share index.
But the volatility we're quite experiencing a quite volatile market lately. I think this volatility is basically coming from a few counters, and I think those counters, I could simply pick Econet and Cassava.
Yes, definitely. I mean, for those two counters, it's always been also my view that they have a very huge influence on the market because of their weighting within that market. These two counters do pose actually inclusive of Delta. They hold about 40% of the $25 billion market there. So any slight movements in any of those three counters, or such huge movements like yesterday, Econet did come up 11%, and the market went in the positive direction the same way Econet
But
did.
the challenge here is trying to determine what's pushing those counters to become volatile, because volatility is normally experienced in counters that are generally weak, but these are strong counters and counters that are now deemed to be value stocks. These are counters that are on the growth curve. Econet, it's been 20 years on the market now, and it's now in its obviously it's now beyond a growth stock. Of course, when you talk of Cassava, you could say it's still within that level where it's still growing at those levels, but Econet fits into a value counter which should be stable in terms of its earnings preservation and also its trading on the stock market. I'm still to unearth why Econet has been one of those counters which is swerving up and down as if people don't know its actual
I
value.
also tend to wonder there, because yes, their earnings have not been very bad, but then, like you've said, that counter is also, it has pretty much almost plateaued in a sense, because if you look at their most recent financial results, they did enjoy an increase in terms of volumes, in terms of their data traffic, SMSs, and voice calls. So with those three parts of their business having some good percentage increases, one of which voice calls, actually SMSs had gone up by 37%. Data is the one that went up 80%, which is a very huge movement. They did contribute, which really pretty much contributed to much of its revenues that went beyond $1 billion mark. Now, with those three aspects of Econet's business, especially considering that they've taken away their media and technology business and put it under the wing of Cassava, I don't see Econet really growing further from the point which it is at the moment, because of the 90% population coverage that they have. I don't know how much more further can they go, and how much more further of the market share can they take.
I think if you try to dig deeper in terms of appreciating the business model, it's not about pushing to more people, because they already have got over 80 to 90% of the population. It's about giving value to those that are existing. How do you put in more products to the existing clients? So you can only put in more products by innovation. So they still have got an innovation hub that's likely to come out with more offerings within the same ecosystem that currently exists. So we'll likely going forward see more offerings. Maybe it's they do car tracking and whatnot. They might still continue to offer services that still leverage on your data, on your mobile phone, that is your network, and of course yes, data and your network. So they will innovate around those
such
same
kind of
yes, they'll innovate around
And
that
I
same
suppose
ecosystem.
I suppose the synergy between them and cassava will keep them
Yes,
very
it
much
will still
afloat
it will
in
still
that
it
regard.
will still be there. So in as much as cassava grows, at the end of the day, it leverages on the same ecosystem that is still housed by Econet. So when Eco Farmer or any other of those services are growing, whether it's via and whatnot, you are still on their network. You're still using their data. You're still using their service anyway. So it will still mean growth on the underlying business. So I think that's one factor that will definitely drive growth. But they've got another dimension that they're taking the company to, which I think is a story for another day. But in terms of volatility, Econet has been one of those very volatile counters.
Yes, I do agree with you there. Very interesting for them to have also mentioned that they have commissioned about 116 solar power plants, where most of them are producing about 3 to 7 megawatts, and that is going to go in a very long way for them in the future in terms of them cutting their costs. Is also considering that we have been in a very, very volatile, energy insufficient economic at the current moment. Just to move on to our weekly trends there, our all-share index is down 0.95%, top 10 index is down by a meager 0.33%, while the industrials is down 1.04%, and the mining's index is still boasting of a strong 4.9%. Now, 16 counters traded today, down from 24 counters that traded yesterday, and 4 traded in either direction. Of those 16 that traded, leaving a remainder of 8 counters that actually remain stable. Now, on one end of the stick, which is the loser side, ZHL did let up 20% for it to settle at 3.6 cents, while Old Mutual added 4.16% for it to settle at 1,460 cents. Now, give me an insight on how ZHL has been performing as of late. Do you think that it's got a very bright future in terms of its share value going up in the near future or long term?
I think the underlying business there is reinsurance. They quite have got a huge presence in the region, and they've recently managed to launch or to try to diversify or to try to de-risk their business from the Zimbabwe from this economy by registering the Baobab reinsurance within a different jurisdiction. I believe it's Botswana there. So this makes them able to continue to underwrite insurance from a regional perspective. Why? Because locally they were no longer able to continue to pay or to meet their claims given the challenges, the USD challenges that are being faced by that are currently being faced by the economy. So I think from that perspective, they've done good. They've got other areas that they're looking at, both domestically and in the region. But their underlying business is still quite strong. In terms of their other investments, they've got a presence in CFI. And they have presence even in our own Zupco, but they've been a dormant shareholder. I think some of those investments have not performed well over the years. But when you look at some of the companies, the offshoots, Fidelity, you also talk of Nikos Diamond before they now become part of. So I think in terms of their business, they're on the right footing. In terms of share price movements, I think insurance is presently under a huge risk due to the erosion in value and the net depletion in terms of GDP that's currently going on. That's a big factor towards driving down consumption of insurance products.
Okay, you just highlighted the risk that insurance companies are under. And yes, we are now in a Zim dollar economy. Prior to that, they had been getting their premiums in US dollar, most of which preferred in US dollar. Now, with the Zim dollar having come into play, what does the structure of that industry look like now? Do we see them coming to some sort of resurgence in the very near future, or they're going to have to rebuild themselves from going forward?
I think the loss here it doesn't pertain to their ability to still continue to perform. Who loses when things get bad is the pensioner whose pension is wiped off. But as for the pension funds, I think they own a lot of properties, they own a lot of equities and so forth. So they will continue to operate, and they're still obligated to meet some of their claims as and when they fall. If there is a claim that is due, they have to obviously meet those claims. So that's where the disadvantage is, because you are probably not getting a commensurate return, and maybe you now have to rebuild something which price has gone up by a very huge margin, more than the growth that you have realized on the funds that were invested 5 or 7 years ago. So that's one of the key challenges the industry is facing. And pricing also is now a challenge, because we have now fully de-dollarized, and so we can no longer continue to charge in hard currency. And that's a challenge as well, because you don't know which value or which price is quite commensurate to the risk that you are presently underwriting.
Okay. Quickly onto Kafka there, which trailed Old Mutual, coming up 2% for it to sort of 127.5 cents. That counter has had a very good edge in terms of interesting me, mainly so because of the business that they're in, cable manufacturing thereabout. Also with copper prices not doing too badly for their business model there. Where do you think that Kafka could see themselves in the future, or are they rightly posed as of now? Do you have an insight as to how they're performing in any regard?
So Kafka has a near monopoly in terms of distribution of cable, and actually they produce copper cable, which is used in electrification of homes and rural areas and whatnot, and it is also used by mining companies and whatnot in terms of their cabling material. But over the past years, there has been a huge influx of other imports that were grey imports, and so at some point they needed protection from those. But as of late, they have managed to win back a lot of market share on the ground, and they supply, their biggest customer is actually ZESA. They supply over 70% of their cables to ZESA, and so they're quite secure on that end. But in terms of their business, copper prices are also of big impact. Why? Because it's a key raw material in terms of their production, and they've been able to generate money from scrap sales of other metals, and therefore they have managed to cushion themselves in times when copper prices are low. But lately they have managed to rebound, given the firmness as well in the copper prices on the global market. Going forward, their success will all depend on of course protectionism, but I think also it's they have quite a competitive operation which has got capacity to distribute even into the region, and so I believe that they are a company to watch. Their earnings have rebounded over the past few years, and they have, I think, what I would call a brighter future.
Okay. Just moving on as we shut off the show today, we have a look at our forex markets. The interbank rates did weaken today, coming up to about 8.67 to the dollar, while the parallel market did give in to the pressure.
Yesterday?
Yesterday, the parallel market was at around
the interbank.
The interbank was at 8.6665 thereabout, if my memory serves me right.
So it hasn't strengthened, it has weakened.
Yes, it has weakened today. But then, contrary to that, the parallel market actually strengthened, coming down to about 9.9 from yesterday's trades of around about 10.1, 10.2.
So it means the interbank rate is actually weakening. It's actually firming in favor of the local currency.
Yes, yes. As of today, and the old mutual implied rate did go up to 9.51.
Don't you think that's a function of stability on the interbank market? Because it seems for just about over the past 3 sessions, we've seen the rate stabilizing at rates of about 8.5 thereabout on the interbank. Because all these sessions before this week, the interbank rate was galloping on a session by session, going up, and the of course the parallel market would have wanted to keep a certain margin, and so after that initial dip, they realized, oh, the interbank market, the interbank rate is actually on a sharp rise. Therefore, let's retrace and redo our margins again. So I think it's about trying to be perceptive of the interbank market, but the only market that can really inform in terms of the actual trades on the market, it has to be the interbank. So the reaction on the parallel market is coming from the actual trades that are happening on the interbank. And mind you, there's now competition as well. You would want to see how you fare if you are to sell your money on the street, or if you are to sell your money on the black market. So these are some of the considerations that are there. You're now competing for resources, and so yes, that's my evaluation around that.
All right, thank you, Respect. Please do not forget to like, follow, and subscribe our YouTube, Twitter, and Facebook accounts at EquityAxis. Don't forget to follow, actually visit our website, www.equityaxis.net. From Respect and I, please do enjoy your evening.